Hi everyone, this is Joy Zheng from New Frontier. Welcome to our performance review for the second quarter of 2020. Today I will cover performance of our investment strategies. As a pioneer investing with ETFs over 15 years, we offer 15 portfolios in three different strategies: global multi-asset standard portfolios, tax-sensitive, and multi-asset income portfolios, as well as our high net worth solutions. Last year, we launched the first ever 6 global indices, ranging from the most conservative 2080 to the most aggressive All Equity Index and NFGEI. The global indices are constructed in the same way as our global strategies. That's why we always like to start the performance with a review of those indices, as they are the most transparent representatives of our investment process provided in real time. You can check our index performance anytime during the day in S&P Dow Jones website, Yahoo Finance, or Bloomberg. This is really another unusual quarter following the outbreak of COVID-19. The second quarter saw a strong rebound, marking the quickest recovery from the quickest decline in Q1 in history. Before diving into detail, I want to remind viewers of the scale of those returns, as all of our indices rebounded dramatically, both in absolute and relative terms. Darker blue bar in the chart represents our index performance for this quarter, and light blue bar for the benchmark. Bars we see below the axis are year-to-date performance. Green is for our index, and yellow for the benchmark. It's very encouraging to see that our conservative index have returned to positive territory year-to-date and outperformed the benchmark by 3%. Our balance index and the GBI bounced back 14% this quarter, and it was barely down 1% this year. Again, very assuring to see that our index declined much less in the Q1, but also regained much more in the recovery. And the GEI, our global equity index, posted its best quarter since 2009 with 20% gain, as much as S&P did. But remember, US is continuing doing better than the rest of the world. Our global indices also allow transparency into volatility of our global strategies. They have behaved as they should in this special environment, with balance index being much less risky and even our equity index being less volatile than S&P. Now we have our tax-sensitive portfolios. What we have here in the chart is our net fee portfolio performance for the quarter and year to date. We continue to see strong rebound with balanced and aggressive profiles posting double digit for the second quarter. Tax-sensitive have performed much in line with standard portfolios. Drilling down, we can see municipal bonds bounce back this quarter. Growth tilt also contribute to the outperformance. We will talk more about assets in later slides. Moving on to multi-asset income portfolios. Again, we have net fee performance here. High dividends began to catch up during the second quarter. The pace of recovery, however, is not as strong as other equities. So compared with numbers we saw earlier, multi-asset income portfolios did not see such a dramatic rebound due to low exposure to growth stocks. In the relative terms, multi-asset income portfolios have recovered much in line with benchmarks in Q2, while they declined much less than benchmarks during March. As a result, we see the outperformance is more pronounced on a year-to-date basis, ranging from 1 to 4%. It's important to remember that multi-asset income portfolios are constructed to be income-oriented. It has been doing a great job in tracking its investment projected, especially in this low interest rate environment. We're providing consistent and a stable yield, which is about 4 to 5%. So that was our index and portfolio performance. Let's talk about assets investing. On the fixed income side, it's interesting to see AG, that is on the top of the table, was up 3% this quarter, the same amount as first quarter's gain, whereas bonds performance have varied extremely. Bonds that did well in the first quarter were almost flat in the second quarter, while bonds that suffered or recovered in Q2. Risk bonds, including corporate credit and emerging market debts, bounced back strongly. Emerging market debt gained 14% this quarter. That was a strong reversal from Q1. Investment-grade corporates have added more than 9% this quarter, with just 3% loss in the first quarter. Despite of risk assets' strong rebound, treasuries are still leading in 2020, having done their job well in the downturn. On the one-year period, long treasuries marks itself as the biggest contributor to the performance, with more than 20% gain. Among those massive movements we've discussed, corporate and high yield were no doubt headlines for this quarter, with Fed's credit facility that lines behind its recovery. And that brings us to the snapshot of high yield credit curve on 3 different days. Now, the first thing you will notice is the flat credit curve on the top, that is as of March 23rd, market bottom. So panic sell-off in credit market during March dramatically pushed up credit yield, especially on the short end of the curve, making it almost flat. Right after Fed announced the plan to purchase corporate bonds, including ETF, to support market, credit curve steepened quickly. That's also reflected in the credit spread as well. Investment grade spread have tightened substantially from the March peak down to the long-term average, indicated by the red line in the chart. Higher credit spreads, on the other hand, also narrowed but remained above the historical level. From these two plots, we can see credit markets have recovered disproportionately, with investment grade outpacing high yield. Now for equities. World equities was up 19%. The figures in different shades speak to the fact of strong but uneven rebound. The most pronounced example we can see here is value and growth. After falling 25% in the first quarter, large cap value regained 12% in the second quarter, but its growth counterpart was up 29% with just a loss of 14%. So put it all together, we have a record gap between value and growth. Typically, one would expect the weaker performing segment to make up more lost ground after change in sentiment, but COVID-19's market impact had the opposite effect. Demand for growth-oriented technology, e-commerce, and healthcare stocks increased as investors piled into those companies that are largely isolated from the effects of lockdowns. Gold continued to climb due to the fear of uncertainty. So in general, we have an amazing quarter for the equities, but not all of them have the same pace of recovery. As a result, high dispersion in asset class, along with the reduced volatility and tightened credit spreads, contributed to the active rebalancing we have been doing. For more details and insights about our recent rebalances, please check out our Chief Investment Officer Robert Michel's latest video on YouTube. Thank you.